Yes. Okay, let's go right into this. Good morning. Good morning. All right, this morning we'll dive into chapter 6 and we will walk our way through chapter 7, hopefully, fingers crossed. And as usual, I'm recording the class so that those that are not able to attend um, can go back and watch at a later time. But the exciting part is that this morning we are moving on to group life insurance. All right. So we've talked about all the individual life, be it term insurance, whole life, T100, and universal life. And we broke it down in details to a great extent. And this morning we are moving on into group life insurance. Well, for some of us, we may be hearing about group life insurance for the first time, but don't worry. You'll be just fine. Okay. So, what
Okay.
is group life insurance? Okay. Know that this chapter only deals with life insurance provided by group insurance plans, and the other benefits provided by group insurance is covered under the accident and sickness module. Okay, so there are other benefits provided by group insurance like accident, health and dental, and all those other ones. Those will be covered in accident and dental modules. As you all know, we have 4 modules. We have life insurance, segregated funds, accident and sickness module, and ethics module. Okay. Now, group insurance is that insurance that offered by the plan sponsor to a group people who shared common association with the plan sponsor. Okay. Now, the plan sponsor, the common association is that all the employee works for the same company, and the employees are the lives insured. Okay. So now in this topic, or rather in this chapter, you're going to be hearing the word plan sponsor. And then you're going to see here lives insured. Okay. So plan sponsors is usually the company, the corporations. Okay. Now basically, Kojo, to make it easy to explain it, to break it down for you, is when we hear of group insurance, is where a situation whereby the company where people works for gets life insurance for everybody. Do you understand?
I do.
Uh-huh. So, and some company does that, some company don't. So the company
Okay.
that does that, they'll be like, okay, all these people that are working for us, we want situation whereby if anything happens to them, their family will get something, right? So
Yes.
they take on that group plan for their employees. So that's what the group insurance is all about. And in that case,
Okay.
it's because the company is the one taking this policy, the company is the owner of the policy, is the
Okay.
contract
Not
holder.
an individual.
Yes. So
Okay.
and now this in this terminology, the company is referred to as the plan sponsor, the one sponsoring the plan. Okay. And then the
Okay.
employees that are part of the plan are called the lives insured. Okay.
Okay.
Now there are attributes that may constitute a group, because anybody cannot just come up and say, okay, now we are a group, give us like we want to get life insurance. No, there has to be an attribute that constitutes a group, that makes that group eligible for a group insurance plan. And one of them is employees of certain employer. That is, the employer must have more than the minimum number of employees as set by the insurer entering the policy, usually 5 employees as minimum. So again, when people work together, for example, we own a daycare and we can choose to get a group insurance plan for our employees. So any of all of our employees are eligible in that case. Why? Because they are employees of our organization. Okay.
Mm.
Now,
Yes,
the
ma'am.
second criteria is students or alumni or specific universities. Some universities, some alumni, some organizations, some professional association might do that. For example, I'm a member of PMI, that's Project Management Institute, right? Because I'm
Yes.
PMP certified. So now PMI have this kind of arrangement that all the PMI members can obtain life insurance through PMI. Okay, so
Okay.
that
Yeah.
is there. And also we have society members, such as members of the society, like we have Catholic societies, there are different societies, group and everything like that.
Mm.
So all those society members will be eligible for group plan through their um
Through
through
the
their
organization.
society. Yes,
Mm-hmm.
okay. Now, so we move on to policy holder. So now we're going to see how this difference now, because when we do individual life, we have policy holders, we have life insured. Sometimes the policy holder is the same as the life insured, but we're going to see how that varies from group insurance. So look at the policy holder. The policy holder is also called the plan sponsor. I said that earlier, right? Now the plan
Yes, ma'am.
sponsor can be almost any organization, society. So the plan sponsor doesn't have to be a human being. It can be an organization. It can be a society. It could be a legal entity. Okay. Then the next thing we will be looking at is master contract. Okay. Oh, but there's a point here I don't want us to miss. Is this point here, which says that a plan sponsor divides its group into subgroup called membership classes. So, for example, when I was in GE is a big conglomerate, right? So we
Yeah.
have the Canadian GE, and the way they structure us in GE, they group us in regions. Okay, so I'm here in Canada, but my region is combined because of my role, right, and the kind of the complex nature of what I do at the time. I work more with the guys in Texas, right? So
Yeah.
now within the same company, you see that the employer groups the employees, and the way the employer may choose to group the employee, it may be based on their level, because it's not everybody in GE that have the same life coverage. Sometimes it's
Mm.
based on your level, based on number of years, right? Some people are
Yes.
only entitled to 250,000, some may have 500. Then the CEOs, the top guys may have in millions of coverage. But because the employer is the plan sponsor, the employer have that power to group, okay, the
Yes.
employees into subgroups called membership classes, and each class receive insurance based on what is defined for them. Okay. Now,
Okay.
coverage appropriate to its need. Now, for example, within a company, executives may receive higher. Of course, executives always receive more in everything, right? They will move on to master contract. All right. You see, you may be thinking that, okay, because this company is huge, they'll have different contracts. No, there's only one contract, and that's why it is called master contract. So we that are employees, we don't have any contract with the insurance company. The insurance company have contract with the employer, who is the plan sponsor. Okay. A policy is issued by the life insurance company to the plan sponsor as a master contract. And the plan sponsor is the owner, the manager of the policy for its members. It is responsible for paying premiums and making decisions regarding the policy. A master contract is issued. Each contract ensures the sponsors employees members, and they are called the group plan members. See, so these 3 points tell us that number one, okay, the policy is issued to the plan sponsor, not to the individual. not to the individual employees. Okay, so it's to the plan sponsor, who is the employer. Okay, and then the employer, who is the plan sponsor, have the right to manage the contract, to pay the premium, and to make decision. You see, they are the ones that decide, okay, you as an employee, we just hired you, so you are at the bottom, and this is the coverage classes you belong to. Or those that have been promoted, they know how to sort. So that is basically how it works. Okay, and this is a very straightforward topic. The master contract issues the sponsor employees on a the master contract ensures the sponsors employees or members, and they are called group plan members. So we, the employees, we are not the owner of the contract. We are just referred to as group plan members. Okay, members have no direct contact with the insurance company. You cannot wake up and say, oh, this insurance company, oh, I know. You, the employees, you have no direct contact, direct business, like we, nothing at all directly with the insurance company. You see, they also have no control over the policy. You have no control over the policy. Okay, now you can, aside from naming your beneficiary and buying optional additional coverage if you like, the only thing you can do as a plan member is that you have that power to name your beneficiary. And some organizations create an avenue where you can add additional coverage. For example, if you want to cover your spouse through the group plan, you can do that. Okay?
Okay.
Group members do not receive a copy of the master contract. They receive a benefit booklet that summarizes all the insurance benefits and rights under the contract. That's all they get. They don't get the contract, they only get what they called benefits booklets. Okay? So we
Okay.
move on to group membership. Now, this is an exam area, okay, because they are going to ask you, the person, someone belongs to a group plan, what are the rights, what can that person do, or what are the role or the rights, or what can a plan sponsor do. So those are there are definitely questions coming from this area. So we move on to group membership. The plan sponsor establishes eligibility for membership in the group plan to obtain a coverage under the group plan. So the plan members must meet this criteria and to be eligible. There are three types of membership plan. So number one is optional membership for association members. So this optional membership, okay, the member chooses to join. The members must be a current association member, and the members who leaves the association may be able to convert their policy. So this is optional. Okay. So for
Okay.
this one, let's say when you're working for a company, the company might make it optional. Say, okay, if you like, you can join the group plan and you'll be covered for your life insurance, right? And then um um and that's it. But the moment you leave the company, you are no longer covered. That was what happened to me. When I was with GE, I was covered. I was entitled to 500,000. If anything had happened to me, my beneficiary would receive 500,000. But the moment I left GE, I was no longer covered. Although GE gave me option to convert the policy to a personal one, which I wanted to, and I had meetings because then with GE we had our insurance plan through Sun Life. So I contacted Sun Life and they sent me their advisors who gave me a quote, and those quotes were freaking expensive. And we're going to see the reason why as we go walk our way through this class. Okay?
Yes, ma'am.
So the second one, remember number one, to be eligible, you have to be a member of the group. And to be a member, some organization is optional. Of course, they won't even force you because is to your benefit, right? Then the second one is optional membership for employees. So here the employee chooses to join and is required to pay a portion, you see, of that coverage. And then the second one is this is called a contributory plan. Now, the one that employee pays part and employer pays part is called what? Contributory plan. Okay.
Okay.
And then in this one, an employee can enroll in the plan after satisfying the group probation. So, like for me, with GE at the time, you can only become member of the plan after you have passed your probation period. And some organization, it may be after 1 year. It depends on how the organization is structured, okay? But just shall remember that um, upon becoming eligible, an employee has a limited amount of time to enroll in the group plan, okay? And then mandatory membership for employees. This one, employee is eligible for enrollment in the group plan after satisfying, okay, this thing. So these are the three membership options, group membership options. Number one is optional membership for association members. This one is totally up to employees. Then number two is optional membership for employees. So this one, what's the difference? Optional membership for association members. Okay, so this one is association members, okay? Now, and the second one is optional members for employees, right? And then this is called contributory plan because employee pays part of the
Mm.
premium and the employer pays part. And then the third one is mandatory membership that an employee can join after fulfilling a certain requirement. Most of the time is after completing their probation period. And they are expected to enroll within a specific time frame. Okay, so moving on to actively at work requirement. So this is another requirement for someone to be a member of the group. You know, some organization you are required when the sponsor is an employer, the employee must be at work on a day, on the day his coverage in the group plan is set to begin. And if the employee is away from work on the scheduled date, his coverage will not begin until the employee returns to work. So some employers structure, you see, this thing is, it depends on employers and, you know, it varies from organizations to organizations, okay? So now we are moving on to um, membership classes. You remember we talked about membership classes at the beginning, how an organization will group their employees into classes, different classes, right? So let's talk a little bit about these membership classes, okay? Now, some employers sponsored plans have more than one membership classes within a single group plan. You see, it may be based on their labor, the kind of work they do. It may be based on their admin, okay, or management. For example, different classes that exist in the group plan. These are example, okay. A schedule of benefits, um, membership classes. So this one, we're going to see that in section 2.1. The membership classes different from one another in coverage, okay? So now, some organization may put some clerical staff in a particular, whereby the group classes is structured based on roles and responsibilities, all right? And some organization, it may be based on the length of service, okay, how long this person have invested into the organizations. They may say, okay, those that have been in our organization from 1 to 5 years, they belong to this class band. Then from 5 to 10 years, 10 to 15, 15, you know, like that. Or some organizations, it may be clerical staff, admin staff, factory, then they'll start talking about managerial staff and stuff like that. So again, it varies. And we can see that in the example here. Okay. Now let's talk about premiums for a group plan. How is premium structured in a group plan? Now, for premiums for group life insurance, they are based on coverage characteristics of the group. So individuals are not singled out. So they, like when we run quotes for individuals, we put the person's age into the software, like we discussed in the first five chapters that we've treated before now, where age and gender drives the premiums holistically for the most part, right? So in terms of the group plan, it's completely different because premiums for group insurance are based on the coverage, the average characteristics of the group. Okay, individuals are not singled out. For example, the health of individual. That's why group plan is always the best for people that have underlying condition, because they are not singled out for eligibility criteria or insurability criteria. No, everybody in the group plan is eligible. Okay. For example, if a life insurance company charges 0.20 for insurance, that rate will apply to everyone in the group, regardless of their gender, regardless of their age, and regardless of their health. Hallelujah. You see that? So
Yes.
that is the way the group plan works. Okay. The insurance company recalculates the premium every year. So every year, you see this one that, for individual, once you have quoted a price, that's what you pay, nothing changes. No, for group plan, it doesn't work like that. The insurance company recalculates the premium every year. Changes are made to reflect changes in the group demography. For example, due to an increasing older or younger employees. So for example, if this year, let's say this company have 30 employees, right? Let's say they have from 20 to 30 years, they have 10 employees. Then from what? Let's say 30 to 40, they have 10. Then maybe 40 to 50, they have 10 employees. Then perhaps next year, there is a complete shift of these young people, 20 to 30. They have no loyalty to anybody. Okay, they can quit on you, leave you anytime. And perhaps those kind of turnover happen to this organization that move these young people left and they hire people that are from 30 to 40. Now they have people that ages 30 to 40. There are now 20 of them, right? So now the insurance company will evaluate this company every year, look at their age, demography, gender, and based on that, they will give them their rate for that year.
Okay, ma'am.
Do you guys get me?
Yes, I
So
get
that
it.
is how they recalculate the premium that the company, the plan sponsor pays on a yearly basis. And then more plans requires the employer to cover at least 50% of the premium, and then an employer may pay the full if they choose to. Okay. Now, some employers pays the premium 100% because the premiums that the employer pays for this coverage is tax deductible to the business. Or some employers will pay 50%, then employee pays 50%. So depending, right? Now for contributory plan, the employer pays the full premium to the insurance company and then deduct the employee's contribution directly from their paycheck. So that is a contributory plan. So for contributory plan, the employee and the employer pays. It may be 50-50, maybe 30-70, depending. All right. So we move on to the tax treatment for employer. So I've already talked a little bit on the tax,
Okay,
but guys, pay
so that
attention to.
sorry, I want to ask a question. So that dynamics has to be the decision of the group, right?
Oh, the dynamics in
Yes.
the employee that leads to their classes, right?
Yeah, yes.
Yes. So in
Okay.
that case, yeah, that is the decision of the plan sponsor, and
Okay.
that is what their dynamics is in that time, right?
Okay. Okay,
Because
ma'am.
when they are hiring people, they are the one that hire older people, right?
Yes.
And by the virtue of the people that they hire, because they already have these existing classes, so when those new hire comes in, they fall into those different classes they belong, depending on the existing class structure that they have in place. Does that
Okay.
answer your question?
Yes, it does.
Okay, cool. All right, so let's move on to treatment for employer. Premiums paid by the employer are deductible as business expenses to the employer. I just said it now. Do we understand what deductible to the employer means?
Uh,
Yeah?
Deducting from their pay.
No.
It's not.
So I'm talking about tax treatment. This is exam this thing favorite too.
Okay.
We'll ask you the premium paid by employer for a group plan premium is what? So just know that the premium that employer pays
Mm-hmm.
as a premium to the group plan
Yeah.
is deductible to the business because it's referred to as business expenses. Okay?
Okay. Yes, you said yes.
Now, the tax treatment to employee, all right? The premium paid by an employer on behalf of a group member are a taxable benefit to the employee. Almost. Hmm. Do we see that? So
Okay.
now let me break it down like this for you guys. So, like, I'm an employee, right? And
Yes.
then I work for XYZ company. Okay. So I have, let's use my example with GE, which is a real example with GE, right? So I work for
Okay.
General Electric, and I'm covered to the tune of 500,000. And let's say every month GE pays $50 on my behalf to Sun Life for my life insurance coverage. Are we good?
Yes.
Aha. So now that $50 GE is paying for me is tax deductible to General Electric.
Okay.
However, that $50 is considered taxable benefit to me. So that $50 is taxed in my own hands. So
Okay.
that is a tax treatment for employee. So premiums paid by employees are not tax deductible. And also the premiums that I pay are not tax deductible, which I feel is highly unfair, but it is what it is, right? The benefit
Yes.
paid by the policies are tax-free, okay, to the employees. Okay, so we
Okay.
can read this example when we have some times. Okay, now
Okay.
let's see how the sales tax on premiums are treated, because you will see how the sales tax on premiums are treated for individual policy. So let's take a look at how these are treated for um group plan. Okay, now a tax on premium is charged by provinces or territories, the same as it is for personal policies. The tax ranges from 2% to 5%, depending on the promise, okay? Retail sales tax is also charged on premiums in Manitoba, Ontario, and Quebec. GST is charged on administrative fees. All right, so let's look at group term insurance coverage. Now, insurance coverage is restricted by the term of the plan. A prescribed amount of base coverage is automatically provided to all members. Some plans provide members with the option to purchase additional coverage. Insurance is usually provided in the form of yearly renewable term. Again, this is very straightforward. What this is talking about is that everybody get the base plan, you understand, then it builds up from there. For example, if the base plan is 250K, so it means that whether you are an entry level, you get that 250K because that is the base plan. Then it start going up from there. They hire your grade or classes and stuff like that. All right, let's move on to schedule of benefits. So how does this work? So the schedule of benefit describes the amount of coverage provided as the base. And if a plan has different membership classes, then a different schedule of benefits will apply to each class. Coverage can be increased by one of the following four methods. Okay, so again, this is building on what we just talked about as the base coverage and then the schedule benefit. Some organizations, the benefits are scheduled based on the way the group classes are structured. And then depending on what class you belong, that is what determines the schedule of benefits you are entitled to. Okay. Now, there are four methods by which the schedule of benefits can be increased. Number one is earning multiples. So how does this work? This earning multiples coverage uses the group members' base salary as a starting point and add a multiple of that base or portion of that base. For example, a CEO may receive coverage equal to twice her salary. The plan may specify maximum coverage. So this is a multiple. This one is referred to as a multiple schedule of benefits. Whereby, for example, if your salary per annum maybe is 100K, okay, the company will say, okay, your schedule of benefit will start with twice your salary. So if this person earns 100K, twice that salary will be 200K. So that will be the multiple of benefit the person will start with. And then the plan may specify the maximum. It may say, okay, to the maximum of 250 or to the maximum of 300, depending. Okay, because where there is a maximum of 250 and this person earns 150 per annum and it says twice the salary, and we can see right off the bat that twice the salary of this person would have been equal to 300K, then what would this person receive as benefit? Unmute yourself, let me hear you.
I didn't get your question. You said what?
I said that the schedule of benefit where is in multiple, like in number one, which is multiple benefit. And I explained that for the multiple schedule of benefit, what the organization does is they could say it twice the person's
Okay.
salary or three times the person's salary, and to a maximum of, because if the person is earning 500,000 or $1 million and they say this person's benefit will be twice their salary, and twice the salary will be 2 million, and the organization cannot afford that or don't want to do that, then that will throw the organization out of whack, right? So the
Yes.
organization will say, okay, this person, your salary is 100K, right?
Mm-hmm. Okay.
Now, and we want to give you three times your salary. However, the maximum cap is 250. So
Okay.
what would this employee receive in benefits?
What would the employer receive as what?
As benefits in this instance?
Would it be 250? That would be like two now, twice the
Yeah,
salary.
that is the cap, right?
Yes.
Yeah, so this
So
person
that
will
would be
receive.
two.
Yes, that's the cap. You receive the cap. You see, if the multiple of the benefit, it may be 1 million, but if
Mhm.
the cap is 300, that's what the person gets. Okay.
Okay. Yes, ma'am.
Um, Let me take a quick bathroom break. I'll be right back.
Okay, ma'am.
All right. So we move on to the next one, which is flat rates. Okay. So in this instance, a flat rate coverage, every ground members, every members receive the same dollar amount of insurance, regardless of your position, regardless of your salary. So this one is more or less like a leveling ground for everybody. All right. Then the next one is length of service, and the fourth one is combination, okay, whereby employee salary and length of service can be put into consideration. So this is very much straightforward. So we see situation where benefit is a multiple, then we have the flat rate, then we have length of service, and then the last one is combination of both. Okay, now the next one is coverage maximum. So most plans place a cap on the amount of coverage so that no single members receive more than a maximum that is stated in the group plan schedule. Okay. So the next we're going to look at is reductions for older or retired group members. So how does that work? A plan may reduce coverage for older or retired group members to control premium cost for the balance of the group. Okay, so this one, you see this a lot, maybe situation whereby it's an organization, because if it's employer-employee relationship, people are 65 is retirement age, right? Or perhaps these people are older, they're around 60, and from what we've learned so far, you can deduce that the moment people start getting older, their cost of insurance start going through the roof. And because um this is a group plan, is a yearly renewable term calculations, and is mostly the cost of insurance goes up every year. So we're a situation whereby um this group plan have older people, okay, or maybe retired individuals, and it's costing them arm and a leg, then they can choose to reduce their coverage in order to reduce their premiums, okay? And that's why you see here that a plan may reduce coverage for older or retired group members to control premium cost for the balance of the group. Okay, remember the coverage provided is yearly renewable. Okay, yeah, so that's what I was just saying, right? And the YRT cost for older members will be much higher than those who are younger. So their higher cost can increase premium cost for all group members. Okay, awesome. So that is on that one. So we'll move on to optional additional coverage. I mentioned this briefly earlier, but let's take a good look at it in this section. You see, some plans allow their members to add coverage to their base coverage, and the additional insurance is also optional, okay? The plan member pays the premium for the additional coverage. So for example, if the coverage limit for a particular organization, let's say it's 500, and I want a million, right? Then I can make it a million, but that extra 500 is my own responsibility to pay for it. So this is all this is talking about. The plan member must be enrolled in the group plan, and the proof of insurability is usually required. Aha. So now, when you're a plan member, your base coverage, you don't need to show any proof of insurability. But the moment you are now getting more coverage, then you might be asked to provide proof of insurability. All right. So let's go ahead and read this here. Pretty much straightforward. We don't need to waste time on that. Then we'll move on to term coverage. Okay. Additional coverage that is provided is term life insurance, and it is sold in units, and members can buy as many additional units as they desire. All right. So again, now when you are part of the group plan, you cannot say, oh, okay, I'm part of a group plan, I want to buy a universal life, or I want to buy whole life, or I want to buy 10 to 100. No. You see, the additional coverage you can subscribe to will have to be a term insurance. Okay. Now, why would people want to get additional coverage? Well, additional units of insurance are typically less expensive, okay, and then the cost is cheaper, all right, as you can see here. Now we move on to permanent coverage. Well, a permanent insurance is something offered instead of term insurance as additional coverage, but this is rare. This is more commonly an option for policy conversion. Yeah. So again, like I said, you cannot be because you are part of the group and said, okay, yes, hey, you guys, you know what? I'm part of this group, and as a result, I want permanent. No. You can take advantage of conversion. Maybe you are leaving the company and then you want to convert your insurance, you can do that. Okay.
Okay.
Now, we move on to dependent life coverage. So, dependent life coverage, that is, the spouse and children, may be covered without proof of insurability if the plan member applies for their insurance within a short period of time after joining the plan. So, again, like yes, you can subscribe, to cover your spouse and your children, and they will not have to provide proof of insurability. But there's a time frame to either which you must exercise that option. Okay.
Yes, ma'am.
So again, this is straightforward. Coverage begins after 15 days. All these dates are a function of organizations, and this may vary from organization to
Yes.
organizations. Now let's look at how is death benefit treated when it comes to a group plan. Okay. The death
Yes, ma'am.
benefits under dependent life coverage is quite modest compared to the coverage on the member's own life. So the optional spousal coverage available under some plans. Okay.
Yes,
Now, while the actual amount will vary with the policy, dependent coverage is usually in the realm of 5,000 to this. Now let's look at premium. Each group plan members with dependent life coverage may pay the same premium regardless of the number of dependents. Oh, that's a good one. Some group plan requires separate payment for each dependent. All right. And then coverage you see is very low. Yeah. So when people are able to insure their dependent through the group plan, it's usually cheaper. Okay. Now we have survival income benefit. How does this work? Well, some group plan provide the option for the survivor of a group plan member to receive a monthly income benefit, and the amount paid is a percentage of the plan member's monthly salary before death. And this is normally an optional benefit that can be purchased by the plan member. So this survival income benefit, so this one um is not provided by the plan sponsor. So this is an add-on optional that is open to the plan members. For example, if a husband works for an organization and he subscribed to this plan, which is survivor's income benefit, maybe this person's salary is 5,000 every month, and this person buys this plan because this plan member is the one subscribing to this, so the plan member will be responsible for paying that premium. So what will happen is that when that plan member passes away, the beneficiary will be receiving amount equivalent to the plan member's salary, okay, every month. All right. Now we move on to benefits amount. As discussed, the benefits the spouse receive is a percentage of the plan member's monthly salary before death. Okay. And this one is speaking to this beneficiary, sorry, this benefit amount.
About
Okay. So that is what this one is speaking to. All right. And then move on to accidental death and dismemberment. Well, a group life insurance plans usually offer accidental death and dismemberment as part of the group benefit. So death must result from an accident, and the benefit paid is an extra benefit over and above the base. So now a group life insurance plan usually offers this accidental death, and situation whereby this is offered and the person dies as a result of accident, right? So this benefit will be on top of the life insurance. So it means that there will be a two benefit payouts, okay? There's something here they want us to understand. You say, understand the dismemberment part of the AD&D plan, okay? The insurance company will pay a lump sum equal to the base death benefit or a percentage of the death benefit. It is paid as a lump sum when the plan member loses a body part or body function as a result of an accident. So there's accidental death, then there's the other angle to it, which is dismemberment. So if there's an accident and there's a death resulting from that accident, then the full benefit will be paid out. But when there's
Okay.
an accident and there's a dismemberment that results from that accident, then there will be a calculation of how much
Will be
portion of
paid.
that will be paid, of that amount to be received. Okay.
Okay.
Then we move on to basic versus voluntary AD&D. Now, basic AD&D is automatic coverage provided by the plan. So once it's basic, it's automatic. Then when it's voluntary, then it's optional. It means the plan member will have to subscribe for it, okay? And if the plan member dies as a result of accident, then the calculation of the death benefit will be death benefit plus number of units valued as an additional AD&D.
Okay.
All right, so there's a small example there. All right, moving on to coverage for dependents. I hope we're enjoying the class so far.
Yes, we're moving.
So much information.
Yes, yeah. We'll cover it up. We'll
Anyways,
cover it up
that's
and do the
why
example.
I have my coffee here because I don't know how I'm going to. So we move on to coverage for dependents. Well, the coverage for the spouse and children of the plan member is optional. Okay, coverage is a percentage of whatever the plan member is offering. Then we can read this example to see how that is broken down. Okay, so now let's take a quick look at exclusions. Exclusions. How does it work here? All right. Now, uh, conversion privileges, exclusion. So death must be caused by accident for accident and accidental death and dismemberment to pay out. Okay. The common exclusion to payment of the benefits are injuries that are self-inflicted. You understand? Injuries that are caused by war, okay, or service in the armed forces. So injuries that are caused when committing a crime. So if somebody go and create crime and stole a car, and in the process of running away from the police, he or she crashed and died or lost the function of somebody part. No, this payment will not, this money will not pay. Okay. And then there's another one here. Overall limits, the explosions and caused by committing crime. And then there's this one caused by impaired driving, and the accident caused by piloting a non-commercial aircraft. Okay, so those are the exclusions. So let's move on to overall limits. There will be a maximum number of AD&D units of coverage that can be bought. So again, it's always good to read those contracts, understand those contracts to determine the maximum limits and stuff like that. Then let's look at conversion privileges, okay? Well, for conversion privileges, these are coverage under a group life plan that may be converted to a personal policy with the same insurance company. If the plan member leaves, okay, and due to retirement or change of employer, or if the plan member no longer a member of the sponsoring organization. You see, so that is what I've talked about this earlier. That was what happened to me when I left GE. So I was given that option to convert my policy from a group plan to individual life insurance. But remember, that can only be done with the same company. Okay. And also because if an employee is leaving the employer and that employee is no longer a member of the group plan, all right?
Okay.
Or situation whereby it is the sponsor that terminates its plan. Okay, so when the sponsor terminates, well, for example, if the sponsor feels like, you know what, this money is beginning to be too much and our company is going through hardship, guys, we cannot continue to pay the premium for this group plan. And for that reason, we are going to terminate our group plan. Then the option will be given to all the plan members to convert
About it.
their
Okay.
individual one. So there's an example here. All right. So now in Quebec, Quebec always have their own. All right. So we don't need to look at Quebec. Don't even bother yourself. Because if you want to be licensed in Quebec, you write a different exam. So you
Okay.
write their own exams. So don't even bother. Okay.
Mm-hmm.
I don't know why they're telling us about master contract termination in Quebec. You know, let's look at premiums upon conversion. How does that work? You see, when a plan member converts their group plan to individual plan, the concept of adverse selection applies to converted policies. And that is those who are most likely to be uninsurable or have a higher risk of dying apply for conversion. So this may be because conversion does not require proof of insurability. Therefore, the plan members may receive um again when I move may receive insurance for which he will not otherwise qualify.
25.
So this increases the insurance company's risk. Therefore, premiums may be higher on a converted policy than a brand new individual policy. Let me break this down for you guys with my own personal experience. Because when I left GE, I reached out to Sun Life. They say, hey guys, um, I'm no longer with GE and what do I need to do to keep my insurance? So they gave me all the options to convert. I said, okay, I'd love to convert. But because I'm coming from a group plan, I still have that insurability benefit right? But the insurance company at this point know that they will be assuming risk that they don't know anything about, number one because they are not going to examine me. They are not going to run any medical on me. So they are assuming unknown risk. And what does the insurance company do every time they are taking on an unknown risk? Guys, unmute yourself and talk to me. What do you see them do since the beginning of this class?
Hmm. If the insurance company is going on an unknown risk, mm,
I'm listening.
is it that they'll have to like instead of going on their unknown risk, is it that they'll have to take like do the background checks for the individual instead of going on an unknown
No, no.
risk?
Every time an insurance company is insuring somebody
Yes.
and they don't have to do any medicals,
Okay.
right? The price for that person is usually higher because they are
To cover
insuring
up for
you.
the risk.
Eh?
Is it to cover up?
Yes, so that in case anything happens, and yeah, just to protect themselves to a great extent. And
Okay.
if you know you are in good health, then you let them do, you go for a new policy, which was what I did. Because when I left
Okay.
GE and I wanted to convert my group plan, the quote and the rate I got was freaking expensive.
Okay.
Okay. But when I now went for a new policy, because for with the new policy, of course, they'll do my
Run all
medicals,
the
they'll do everything. They now see my state of health. They know that okay, this is a low risk, this woman is healthy. Then my
okay.
premium was significantly lower.
Low. Okay.
Okay. So that's one key point you need to note, that
It will be
converting from a
higher.
group plan to personal is always higher because,
Higher. Okay.
yeah, okay. Now let's talk
Okay.
about replacement contracts. Okay. Now, a sponsor may choose to change a group insurance companies. All right. A company like GE was with Sun Life, right?
Yes, ma'am.
They can choose to move from Sun Life to Manulife
Okay.
and replace Manulife, right?
Yes.
And replace
Sorry.
Sun Life with Manulife.
Yes.
That is totally possible.
Okay.
But there are guidelines set by CLHIA to ensure that members should not lose coverage as a result of such a change, unless they were members of a class that is not covered by the
By
new
the
plan.
new plan.
Okay, so
Mm.
that is important to note. Now let's move on to benefits amount. Okay, now benefits amount should not change as a result of a replacement of contract, provided that the plan member is eligible under the term of the new contract. So while the company is changing the insurance company, members should not lose their benefit. Okay, so
Okay.
let's look at disabled members. A waiver of premium is included for group plan members. If a plan member becomes disabled, the CLHIA guidelines requires that the premium must continue to be waived and covered, okay, even if the employer terminates the group contract with the insurance company. Okay, so this one, I enjoyed this benefit because all the time I was with GE and I had my kids, whenever I'm on mat leave, the plan member still continues to pay my premium. I still enjoy my coverages, even though I'm not going to work, even though I'm on mat leave. And what this is saying is that even if you are disabled or on disability, right? Um, your premium should not stop so that your coverage doesn't stop, right? So
Yes,
let's
ma'am.
look at group creditor insurance. Okay. A creditor is a person or company owe money by a borrower. For example, being bank lend money to homeowners in the form of mortgage. Okay. And the big
Yes.
banks is the creditor. Okay.
Yes.
Now, most financial institutions offer creditor insurance to their customers. Group creditor insurance establishes a financial institution as the policy holder, and the people to whom the financial institution lend money are the plan group members. For example, Being Bank is the policy holder. So the best way to understand this one is like CMAC, CMHC in Canada. Okay. So do you know
Okay.
that when you take those home insurance, home um 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 mortgage, okay, you were asked to take a CMEC, right?
Okay.
Who else is here on this call? Let me see. Okay, so it's just us, right? I
Okay.
wish there are people here on this call that have bought a house. That would have helped drive this. Because in Canada, when
Yes.
you're buying a house and you're putting down less than 20%, okay, the bank
Yes, ma'am.
expects you to take a CMEC. So what that means is that, okay, you're buying a house, the house is 400,000. All
Okay,
right.
ma'am. Yes, ma'am.
Now you are depositing 5,000. So it means you are owing 350,000,
Yes, ma'am.
right?
Yes,
Now,
ma'am.
even though we go to bank, let's say you go to RBC
Mm-hmm.
to take this mortgage, this this 350 is not coming to you from RBC, right?
Okay.
RBC is going to seek this 350 from a big bank that are known for lending all these big monies, right?
Yes.
And as a result, this big bank will put you, the homeowner, into a group plan with this big bank. This group plan now, group plan of, of debtors that are owing this big bank, right? So, and this
Yes.
big bank now
Yes.
say, okay, now that you are in our plan, okay, your premium every month for us to lend this money to you will be $50.
Okay.
And this $50, your amortization is 25 years. So you'll be paying this $50 every month as you pay your mortgage until you pay off your mortgage.
Mortgage. Okay.
So that is what all this house everybody is buying, because back home, every houses we build our house or we buy it. It's just of recent I heard they are now giving mortgages back home. But during our own time to qualify for mortgage, you need a whole lot to
Yes,
prove
sir.
before you can borrow money to do
Borrow
anything.
money.
You
Yes, sir.
understand? So,
Okay.
but here, no, they've made the process seamless. It's okay, come, everybody is qualified. Do you understand?
Yes, ma'am.
So, this is the way the system is wired to function. So, this is the one that is called creditor. Let me scroll back up. A group creditor insurance, basically. It's just like the same way too. Somebody go to a car dealership. He says, I want to buy a car, right? So that dealership is not the one giving that loan. There is a provider, financial provider that will give the loan, whether it's 50,000, right?
Yes.
Mhm. So this is how this thing
It
works, and
works.
then it's straightforward. So for it to be read like that, and because of that, we also have debt benefits. So the debt benefit is usually equal to the outstanding loan. Okay, for example, if you like the case of mortgage that I give now,
Yes,
right?
ma'am.
So whatever, if the person is owing, the debt benefit to be equal to whatever that person is owing. Mhm.
Okay.
So then we move on to premium. How is that premium calculated? Well, underwriting for creditor insurance is not like underwriting for personal policy. So factors taken into consideration for creditor insurance are age and smoking status. Okay, so these are the things that creditor insurance put into consideration. All right.
Okay.
So let's look at additional coverages like creditor group policy may also cover critical illness, disability, and sometimes unemployment. It may be part of the base policy covered separately. Now, benefits may be paid for the entire period of disability or a specified period of disability. Now, in terms of CI, um, critical illness, the insurance will pay off the outstanding balance of the loan if the borrower is diagnosed with a covered illness. Okay. So again, we treated CI in details yesterday, I believe. Right. Now let's look at unemployment. So the creditor is paid a monthly benefit to a specified dollar amount and for a specified period of time. if the borrower becomes unemployed
Unemployed.
through a no fault of his. Okay, so if a creditor insurance is taken and part of the coverage covers unemployment, so that is the situation that will likely happen. All right, so let's look at a table here for life insurance, group life insurance, and individual life insurance. So this table breaks it down for us. See, I will recommend that we take time to look at these differences, and it will help us a great deal. And with that, we have come to the end of chapter 6.
Chapter 6.
Yes, so we're going to move on to chapter 7. But before we do, I think it'd be nice for us to take a quick break, maybe a
Okay,
10
ma'am.
minutes break, stretch our legs, stretch our back, drink water, coffee, bathroom break. Maybe I'll
Okay.
probably take a quick drive to Tim Hortons and get some sweet sugar to help me
Okay.
navigate the next chapter. All right, so I will see you
Alright.
guys in 10 minutes, okay?
Okay, ma'am.
Yeah, let's pause this. Okay, welcome back from our quick break. Moving on to chapter number 7. So this chapter this is not to scare anybody, okay? But here I will say let's bring out our pen and paper, okay? Bring out your pen and paper because we'll be doing lots of formulas, lots of calculation in this chapter. So what are the key concepts that we need to be on the lookout for in this chapter? Um, I wish there is a way I can make this wider. Is there a way to do this? Let's see. Add comment. No, I don't want to highlight. No. Because every time I move to the next page, I don't like the way this thing,
Yeah, you will not be able to read the
yeah.
first part.
Mm.
Some stuff like
And if I make it smaller too much, it
you won't be
becomes difficult to see. Um, I guess I'm going to have to live with it just the way it is. All right. Well, here are the key concepts that we are going to be looking into as we dive in into this topic. Tax-free debt benefit, policy dispositions, policy gains, and adjusted cost basis. I mentioned this yesterday. You know, this particular adjusted cost basis, oh my goodness. When I was studying for the exams, this adjusted cost basis, it looks so like a big deal. But now every time I run illustrations and I'm like, okay, so is this ACB? If I even to remember the word ACB, I will see ACB, I'll be thinking, okay, what is ACB again? What is ACB? So I'm saying this to let you guys know that look, um, some of these acronyms, you might be coming across them for the first time. And after you might be wondering, what is ACB? You can't even remember that it's adjusted cost basis. Don't worry. Do you understand? And that's why
that.
I'm going to keep emphasizing. Let's go on a field trip now that you guys are studying this material so that the practical and this theory will come together to bring this whole experience and knowledge home for you guys. Okay?
Okay. Okay.
Don't worry, I will share my calendar with you guys later today, or somebody reminds me in the Telegram group so that
Okay.
I do that. Okay. Now we'll be discussing ACB, and it should be discussed in details. So now let's dive into a tax-free debt benefit. Well, we'll be hearing tax-free debt benefit, tax-free debt benefit. Every debt benefit of life insurance contract is 100% tax-free. Okay, the death benefit of a life insurance policy is paid to the beneficiary tax-free, and this holds true regardless of how long. If we take policy today and the person dies tomorrow, it will be paid. If 1 million policy is taken today and the person dies tomorrow, that premium, that death benefit will be paid. Okay. So as we can see in this example, did you say something?
No, no, no. I said okay, ma'am.
Sorry?
No, I said okay.
Okay. All right. So we move on to death benefit includes original face amount plus entire amount paid out upon death benefit life insurance. Okay, so this one is talking about universal life. So for universal life that have plus benefit plus fund, that is the death benefit plus the fund. So the total, for example, if the death benefit is 1 million and the cash value is another 500,000, then 1.5 will be paid to the beneficiary tax free. Okay? Mhm. So we move on that. Again, the example is here. I have this one for us. So we move on to number 2 is policy disposition. So death benefit tax free and tax free. Then the second one is what? Policy
Policy disposition.
disposition. Okay. Now, why is then again? So remember, this topic is all about taxes on life insurance. Okay. So is that not the topic? Is that not the title? Let's see.
Yes,
Yeah, taxation of life
that's
insurance
okay.
and the tax strategies. So all this one is all about taxes, taxes, taxes. And they've told us that they are going to be looking at this from 4 different aspects. Number 1 is tax-free death benefit. That one is easy, straightforward. No calculation is needed. When person dies, the money is paid, the cash value, everything, gbogbo tigbo, tax-free. So you can see that that's why whatever it is, example, everything is straightforward here. We don't even need to calculate. If they will give you a question here just to confuse you and test you that you understand the principles. If you don't understand the principles, you see the death benefit tax free, then they'll now list something that this will be deducted and give you some wrong calculations there. You understand? If you don't know what you're doing,
Yes.
you go and fall into the
Quite
pit.
calculation.
But that is the whole essence of this class, so that you will see their trap and know their trap. You get what I'm saying?
Yes.
Mhm. So, and that's why we are able to move fastly to policy disposition. Now, every time you hear disposition in life insurance, policy disposition is all about means to get rid of something,
Okay.
to say, hey, I'm not doing this again. Hey, I'm done. This is where I'm stopping this relationship. You see, because insurance is a contract, right?
Yes,
And
ma'am.
is this in contract involves the contract holder, which is a policy owner, and the life insurance. And when there's a contract between two people, one person, even if there's one person can walk away, but there are implications to those walking away, right?
Yes.
So in this time around, the implication of walking away, we've discussed all those, we've discussed all those this thing, but now we are discussing the implication of taxes on walking away. If you say, okay, you've had this insurance contract for the past 10 years, right? And then
Yes.
in this 10th year, you say, okay, I am done. I'm not doing again. So how are the taxes going to be calculated? And on what? And, so these are the things we are talking about when it comes to disposition. So whenever you hear disposition in insurance, they are talking about getting rid of, or when you say, I'm not doing again, or when you stop. You get what I'm saying? Just looking for different words to drive this home, okay? Dispose means to get rid of. The disposition of a life insurance policy may result in tax for the policy holder. Do you understand? Because when we say that life insurance, especially universal life, grow tax free, that does not mean that if you decide to take money, that there may not be tax implications, right? And that's where utilizing strategies of collateral loan or policy loan that we discussed yesterday were a good strategies. You get what I'm saying? Because as long as that money sits down in the plan, is tax-free. But any other time we are taking out before death happens, there might be tax implications. And it's those in between. Okay, so guys, oh, assuming I'm preaching now, I'll be saying, oh, thank you, Lord Jesus, because there's this way of explaining it that I just received. So here we have death benefit. Here we have the beginning, right? And then in between here, so you guys look at what I just drew. Let me stop sharing so that I see. Let me see. Okay, to the camera now. Okay.
Yes.
So you see, there's a beginning. This when we
then,
establish the policy, right?
yes. Yes.
Now there is the end, which is death benefit. So at the end here, this death benefit is 100% tax-free, right?
Okay.
But
Yes.
in between, this policy is growing cash value here. So let's say in between here, we have 100K, right?
Yes.
So if in between here is 100K, so long as this 100K stays in this plan, it does not trigger taxes.
Okay.
You get me so?
Yes.
And if it stays here until the end and the person passes away, the beneficiary receive this 100,000 tax-free.
Tax-free. Okay.
But in between here, as it is now, if this person wants to take this money now, right, there
Yes.
might be tax implications here. So this tax implication that could happen here now, how do we calculate it? That is what we are talking about. Okay?
Okay. Yes, ma'am.
So now let me go ahead and share my screen now, but give me a second. So you understand what we are discussing, right?
Yes, ma'am.
So is that in between that we are talking about now? So now that in between, at this point, it's 10 years into the plan. This Mr. Klein have 100,000 in the plan. And now he says, okay, I do not want to continue with the plan again, right? And as we read yesterday, the Mr. Client is entitled to this 100,000 because that is the growth in his investment. The insurance company cannot say, okay, because you say you are not doing again, we are keeping the 100,000. No, it's illegal. So now, as Mr. Client is taking out this 100,000, what are the taxes that may arise? So that is all what this is talking about. Okay.
Okay.
So in addition, in actual policy disposition, the policyholder has to give up some or all his ownership right to his policy. An example of individual getting rid of all his or her ownership will be when a policyholder surrenders a policy and receives the policy's cash value. Okay, so when you hear of dispositions, disposition and surrender, they go hand in hand. Okay, now an example of an individual getting rid of part of his or her ownership would be when a policy holder takes a policy loan. Okay, now when you take a policy loan, right, you are taking money against that policy. Let's say, coming back to this our example now, Mr. Client says, okay, I do not want to pull out completely, but I want this 100K. So I want a loan. So while a policyholder may not give up ownership right to a policy, other events or transactions may result in disposition, or that may result that will make the policy to be deemed as disposition. So this is where the policy holder is considered to have gotten rid of some of the rights, okay? So I've talked about that. A policy dividend is in disposition. So we're going to see that in section 7.2. So how is a policy dividend deemed as disposition? Let's look at that. Policy surrender, policy withdrawal, policy loan, policy dividend, assignment or transfer of ownership. So what this is telling us is that in the middle here, there are actions that we can take, okay, that could limit our rights, okay, partly or fully. Now, again, let me show this. So hopefully it's helping. So again, coming from this, our initial example, right? So we are still standing there in that middle. So there are actions we could take against this 100K that could make us lose part of our rights as policyholder, or some or all of our rights. Okay? So let's go back to the text. All right. And those actions could be policy surrenders. Policy surrender is the one I was saying earlier, whereby we say we are not doing at all again. We are done. Okay, I'm not continuing again. So it means you surrender everything. So it means you surrender everything, then your taxes will be calculated based on that for you, based on this 100,000, and we are going to see how these taxes will be calculated. So remember, we have surrender, policy surrender. So if you have a pen, be writing down this thing, because it's going to help a great deal. I don't know about you guys, but for me, it's like my hand, when I'm writing, it sinks information into my brain. Okay, so that's why even though I'm training, I'm also writing, right? Then we go and take a look at withdrawal. Then we look at policy loan. Then we look at dividend, the assignments or transfer, okay, of ownership. So we're going to look into these 5. We're going to break it down one by one. Okay, so the first one should be policy surrender. Okay, I just want to see that I am not losing any aspect of this, because if I go back, policy dividend, assignment or transfer. So when I move to the next page, okay, you see this thing is happening again. So next page should be 176. Let's see. Okay, this is 176. But on top here, let's move this one up. Okay. Okay. So, and then, okay, it's a continuation. So we have policy assignment, and then death of a policy holder who is not the life insured, such that ownership is transferred to another party. Aha, this is a good one. Then we'll move on to policy loss of tax exempt status. Okay. Okay, so you guys are following me, right? Okay, so this is a continuation of what could lead to partial or full disposition. We have policy surrender, withdrawal from the policy, policy loan, policy dividend, assignment or transfer, then death of the policy owner who is not the life insured. Yeah, for example, if a parents own a policy for their child, right? The child is a life insured, so the parents are the policy owner and the ones that pays the premium. So what happens to that policy if the parent passes away, right? So this is okay. This is the one. Okay, then we have here loss of taxes, and we talked about exempt test yesterday, where I did mention about gatekeeping and all that stuff, right? So that we'll be looking at. All right. So I was hoping they are going to start breaking this down, but they are talking about policy gains. Anyways, let's take a look at policy gains first. When the policyholder disposes of some or all of his policy ownership, he may find there has been a policy gain. The policy gain must be reported as an income for the purpose of the year in which it was received. So now what this is telling us is that, so now the policy gain, I want to believe after this now they'll start explaining surrendering of policies and all those other stuff for us. Because this policy gain is just explaining to us, okay, when somebody says, okay, I'm not doing this policy again, going back to that example I show you guys on the sheet, let's say at that point, the money in that account is 100,000, right? So
Yes.
how do we calculate the profit this individual have made as a result of setting up this policy? So the smaller the policy gain, the lower the taxes the person will have to pay. So the policy gain, the way it's calculated, and this is a formula. So PG, which stands for policy gain, is the proceed of disposition in our example, that our 100,000 minus adjusted cost basis minus ACB. Okay, so now adjusted cost basis is whatever premium this person have paid, whatever expenses the insurance company, and the way adjusted cost basis is calculated, we are going to see this. It has different child and grandchildren of dates that they are going to be using to calculate adjusted cost basis. Okay, so you can read
Okay.
these examples again. Like I said yesterday, don't read the example,
Write it down.
study it, understand it, write it down. Write it down. For example, if you are looking at this example, don't just read, except, you see, you know what, let me not generalize, because I'm just saying what I would do, because me, I'm not the smartest person you guys can think of it. Some of you guys might be genius. You just look at something and bam, is registered in your brain. So if you are that blessed, please forgive me, okay? You can go ahead and just do you, okay? Because for me, when it comes to numbers, I have to write it down. I have to make sure I process it well. So that is based on myself that I'm just emphasizing all these numbers, okay? But let's take a quick look at this. Ron surrenders his whole life policy and the proceeds of disposition were 20,000. The ACB was 17,000. So this one, they've given us the ACB. So in our own case, now let's say our ACB for this 100,000 is worth 80,000. So simply what we'll do is 100,000 minus this 80,000. And then the policy gain will be what? Hmm? Then
That'll
our
be
policy gain will be
20,000.
what?
20,000.
Sorry?
20,000.
Yeah, correct. Our policy gain will be 20K. Okay. So this is a direct one. This one, if this is how the exam will come, I will all rejoice. Okay.
Yes.
But now they are going to give us, they are going to school us now on ACB and how are ACB calculated under different circumstances. But don't worry, you got this. Okay.
Okay.
Adjusted cost basis is the cost of a life insurance policy for tax purposes. So the life insurance company calculates the adjusted cost basis and informs the policyholder of the adjusted cost basis amount, which is usually done when when a taxable disposition has occurred. So the larger the ACB, the larger Okay, where was I?
Up.
Up, right? Okay,
Yeah,
so the larger the ACB, the lower the tax. Uh-uh.
because the policy gain is smaller.
Okay, this is 176, 177. Okay, the lower the tax because
Mm.
the policy gain is
It's
smaller.
smaller.
And in the example below, so what they are telling us is that the larger the ACB, the lower the tax. In the sense that in that our example, where the ACB is 80,000, right?
Yes.
So it means the profit is 20,000. But what
Yes.
happens if the ACB is 50,000? Okay, sorry, let me take a step back. So because the ACB is 80,000, the profit is 20,000. So it means that the lower will be our taxes because we pay taxes only on 20K, right, my dear?
Yes.
But what happens if the ACB is 50,000?
And that means the profit gain will be higher.
Huh?
It will be higher. It will be higher because that will make it 50,000.
Yes, profit will be higher because
Yes.
ACB is lower,
Yes.
right? So
Yes.
it therefore means that when we now minus the this thing, the what is that our this thing, the surrender value,
Yes.
okay? Yeah, the policy gain will now be the surrender amount of 100,000 minus 50,000, which is lower, then our policy gain will be 50,000. So it means when ACB is lower, policy gain will tend to be higher.
Yes. ACV is lower.
And then the taxes paid will be higher. Make sense?
Yes.
So you
ACV is
guys just
lower.
understand it. Follow me. Follow me as I take you on this journey. Okay? Uh-huh.
Mhm.
So these are just example here. You can write this down, process it, go through it. Okay. Now, let's get into this now. So there are
That's
different ways that the insurance company calculates the adjusted cost basis. Okay. So
yes.
now, and one of them, number one, is last acquired date, ACB. You see now, you see that is this ACB that drives the amount of taxes that
That
CRA receives.
yes.
Is this ACB that drives the amount of deductions, the amount of money that the insurance company can take as expenses and everything, because that ACB is a combination of expenses of the insurance company, right? We are going to see what constitutes ACB in a moment, right? But now they are telling us different ways that this adjusted cost basis is being calculated. And don't miss me here, please. Don't miss me here. Stay with me. Stay focused. Focus, please. Number one, the last acquired date. Write it down. Last acquired date. So when was this policy last acquired? I've been giving you examples, okay, 10 years ago, but now at the end of the day, it comes down to the date, okay? And this last acquired date is calculated in three different ways. There are three ways to calculate the ACB depending on the date the policy was acquired. So the first one was last acquired, means the latest of the following. This last acquired date means equal latest of following. Number one, when the policy was purchased, when the ownership was transferred to the current policy owner, when the change to coverage was made, that is, Leon acquired the policy on his wife's life and named his son as beneficiary in 1962. And when Leon died in 2006, ownership of the policy was switched to Leon's contingent owner. And the last acquired date of that policy became 2006. Did we see that, right?
I didn't
So
get it.
this one now has to,
Okay.
please note this down. Okay. Let me join you to write this down so that we all don't get lost in the process. Okay. So the way we tracked the last acquired day, I'm going over it again. Number one was when the policy was purchased. Number two, when ownership was transferred to the current owner. Like the example I was giving you guys, with respect to universal life for kids, right? So let's say as a parent acquired universal life 10 years ago. No, maybe 20 years ago. 20 years ago will be, this is 2023, 2013, 2003, correct?
Yeah.
So now, if a parent acquired policy in 2003 and for their child, and they put it there to pay up in 20 years, right? So now, this year, 2023, they have finished paying this universal life and they transfer the ownership of that policy to their son or child that is now 20-something years old. So that will be when the ownership was transferred. So the last acquired date of this policy will be when, my people?
The last acquired debt for the policy will be 2003.
2023. God bless you. Okay, so we understand that, right?
Yeah.
So when the policy was purchased, that one is easy. If policy was purchased in 2005, it's 2005. If it was purchased in 2013, it's 2013. If it was purchased in 2005, there's nothing like 2005. Don't mind me. I'm just rambling. It is what it is. Okay. But the one that's where it gets trickier is when they say where ownership was transferred to the current policy owner. So a policy was transferred first to another owner and then transferred to another owner. We are not going back to the previous, no. The last date it was transferred to whoever is the current owner. And don't worry about it. They are going to give us these dates and this process, this journey, okay? If it's been passed through, several hands, maybe 2 or 3 hands, they will tell you. If it's passed through one person, they will tell you. So you don't need to worry about that.
Okay.
Okay? So we'll move on to the third one. I'm laying the foundation for you, okay? So the third one is when a change to coverage was made. When a change to coverage was made. And I'll give you the example. We have an example here on the screen, okay? But I have a great example I want to share with you guys, okay? So when we started our policy, when we started, getting our life insurance, we started with a blended plan. We had combination of universal life, critical illness, and term insurance. Then later, we make everything universal life. And then later, we increase that universal life. Okay, so let's say we started this journey in 2010. So 2010, we acquired life insurance and it was a blended plan. Then we came to let's say 2018, we converted everything to universal life, right? And then in 2022, we increased that same UL again, maybe for $500 to $1 million. All right. So this is what this is talking about. The last time when a change to the coverage was made. So in this one, my example now, when was the last time a change was made to that coverage?
2022.
Sorry?
2022.
23?
No, 2022.
Yes, you are right. 2022. That is absolutely correct. So, and then note the difference between when a change to the coverage was made and then the difference to that of when ownership was transferred to the current policy owner. Don't confuse the two. When policy ownership and change in policy, they are not the same. Make sense? So now that we have established that, now you understand these three concepts that drives your adjusted cost basis. So look at what they say here. The last acquired date is also important. Okay, is determining a policy's exempt
non-exempt status.
or non-exempt status. For simplicity, policy can be categorized in three groups for tax purposes. Oh my goodness. so, so policy can be grouped in three. So this is where the dates come in. So we have put in into this thing the structure of ACB, right? Now, the groups of policy for tax purposes. Number one, policies. Number the group one policy. Group one. These are the policies acquired prior to December 2, 1982, and that have not been transferred to another policy holder or have not been modified. And trust me, there are people with these policies out there. And it's important for us to know these groups so that in the question, when they tell you, okay, this person bought this policy December 1, 1982, and they have not made any changes to it, and the cash value is this, and you understand, then they ask you to calculate ACB so that you are not thrown off guard, okay? So not the group one. Again, don't confuse these three groups of policies to the other three last acquired date classification that we just take a look at. Okay, so last acquired date speaks to, I'm going back again. Okay, so that last acquired date speaks to when was the last time this policy was acquired? When was the last time this policy was modified? When was the last time an action have taken place with this policy? Are you getting me, guys?
Yes, ma'am.
So that is what we are talking
Last
about,
acquired date.
last acquired date. And to drive this home, we look at what, when the policy was purchased, when the policy was purchased in 2005, and nothing has happened to that policy, is still, the owner remains the same, the policy amount, everything remains the same since 2005, and that will be the last acquired date of that policy. Then the second one is the last acquired date of that policy is also if that same policy ownership have been changed. So when was the last time it was changed to the current owner? So that would be the last acquired date. Okay, and then the third one was, has there been any change to the coverage? When we are saying coverage, the beginning, it may have term insurance, whole life, no, term insurance, universal and critical illness. Let's say in the process of time, the owner decided to cancel or to upgrade or do anything, and now whatever is done to the coverage, the last date of that changes to the coverage will be the last acquired date. Are we good on that? So
Yes,
we have this last acquired date on this side, but now we are talking about the groups of policies, the dates. And this, let me go back again to read what it says. It said the last acquired date is also important to determine policy exempt or non-exempt status. for simplicity, policy can be categorized in groups for tax purposes. Okay, so now they are telling us this last acquired date that we have looked at it from three perspectives that it could happen. Okay, on this side, they are groups into three. So now, the way I write this thing, see, so we have this last acquired date on this side, okay? And then there are three of them. 1, 2, 3. I'm not going to start writing them, okay? But together, they are also grouped into three, okay? We have group 1, which we're going to be talking about now. We have group 2. Then we have group 3. Let me pause recording. I'm not rushing these parts because I want you guys to get this. Okay, so you can see this thing now, right?
Yes, I can see it.
So I'm not writing down the three acquired this because I've discussed that. But when you are doing your own, you can write it down. But last acquired day, we've talked about it. And then there are three attributes to that, right? Which was the last date the policy was purchased, if no changes was made. Then the second one is when was the last time it was transferred, ownership was transferred to the current owner. And then the third one is when was changes made to the coverage. We've established that, right? Now, these three together now are grouped into the three groups. We have group 1, group 2, group 3. Make sense now, guys?
Yes, ma'am.
So let's go now to the group. Now, group 1. So now they've told us that the group 1, we call them the grandfather policies, okay? These are policies that were acquired prior to December of 1982 and have not been transferred to another policy holder or been modified since then, okay? So for me, when I was studying for my exams, the way I remember this December 2, 1982, is to look for events in my life around this time that I can tie to this and locked it down there in my brain. So for me, what I used was the death of my dad. My dad died April 8, 1986. So that was the closest date to this date, right? So at least 86, 82, I draw it closer. So for you,
I just locked my two. I just locked my two.
Oh my God, wow. Wow.
My favorite auntie was born June 2nd, 1981.
There you go. There you go. So you use those dates now to like, okay,
Yes, to
this
lock
is
me
the
down
closest date to this
to this
event
one.
in my life. Do you understand? So when
Yes.
you see that it is something, even when they are trying to confuse me with a date, so long as it's not 1982 or it is because I've tied it to an event,
Yes.
it's crystal clear in my mind, right?
Sure.
So again, this is my own approach, but if you have a better way, by all means, use whatever works for you. But remember, this December 2, 1982, they are called grandfather policy. And these are policies that no changes have been made with them, to them. No transfer of owners, no change in the coverage, okay?
Yes.
December 2, 1982. That is group 1. So the next group, the second group, let's write it down. December 2, 1982. Then group 2, these are policies that were acquired after December 1, 1982, before January 1, 2007. This is where it starts getting really, really, confusing, because this one said this prior to December 2,
2.
So if it's prior to December 2, so it means after December 1, you have to go, because you see, when something starts, for example, if something starts December 2, 2022, what is the end date of that thing? A 1 year end date of that particular item, generally.
If it starts December 2,
Yes, so
2022.
let's say, okay, you sign a 1 year lease contract with your landlord,
Okay.
and you sign that lease December 2nd, 2022. So when does your lease expire?
December 1st, 2023.
God bless you. So you see, these are the things. But if you were to be reading this on your own, I'm sure you'll be wondering, what are they talking about? Because that was what happened. I said, look at these people. So what is December 1 doing again? They've already told us December 2, 1982. Here they are saying December 1, 1982. Hey, Joe, no day, what is it? But look at this simple example of the contractual document of lease agreement I gave you guys, right? If it, with that, because this is a contractual document, so it means that this policy that were acquired prior to December 2 actually expired December 1, 1982, right?
Yes.
So this one now, the second group policies are policies that were acquired after December 1st, but before January 1st, 2017. Oh, well, these people, they're not going to kill person, but we
After
are
December.
equal able.
Why
Do you
didn't they
guys
just use
understand?
why didn't they just use from December 2nd, 1982?
No. Because these are contractual documents. And
Yes, yes,
if they say from December to, it means there is a day that somebody will be hanging without coverage.
yes, it's true.
You get that, right?
Mm.
So here we are. So how do we remember these two dates? The way we remember these two dates is the first one, go back one day. So it will be after December 1st, 1982. And then before January 1st, 2017. So again, you need to remember, what is in 2017 for you? What can you remember with 2017? You see?
Yes.
Me, I remember 2017 because 2017 was a major transition point in my life. That was when we were doing massive construction of our daycare, when we were transiting from work life to entrepreneurs and all those kind of stuff. But again, you figure out how you want to remember these two dates. Okay? So
Yes.
that constitutes our group 2. Then we move on to group 3. These are policies that were issued after December 31st, 2016. Again, back one day,
Yeah.
right? This
Yes.
is before January 1st, 2017.
Yes.
And then this one after December 31st, 2016. Remember, the expiration of 1 year contract prior a year before, so you go back, and this one now is so confusing because you see 2017, you see 2016, you think they are the one wrong, right?
Yes, ma'am.
Okay. So these are our 3 groups. All right,
Our previous stage.
these are our 3 groups. We have our group 1 policy, we have our group 2, and our group 3. Okay, and remember how we are coming from, right? The acquired dates. You see, the acquired date is into 3 components, right? And then from that 3 components, we are getting 3 groups: group 1, group 2, group 3.
Group 3.
Make sense?
Yes, ma'am.
So now, these ones are the ones before December 31, 2016. or previously G2 policies that have lost their status. Now, AG1 policy will lose its status and become AG2 policy if ownership is transferred. So anywhere you see AG1, they are talking about a group
Group two.
one policies,
Okay.
okay? So
Yes.
whenever a group, you understand, changes its status or whatever, then they lose that group status, okay? For example, this policy that was acquired prior to December 2nd, 1982, and have nothing done to it, and then come in 2017. Okay, let's say January, let me see, 2017, let's say January 5, 2017.
Mm-hmm.
Boom, there was a change to a transfer of policy owner to another person. So it means that policy have lost its group status from group one now to what group?
So group two.
To group two. You get now, right?
Yes, ma'am. Yes, I do.
So
Because it
that
has
is
been changed from one ownership to another
mm-hmm.
person. And then it
So
was done after January 1.
exactly. So let's try and read. Let me put down the dates because writing the dates down is very important, because when you are now looking at other stuff, this one is before December 2. Is it before December 2?
The one in 1982 is before this one.
Last acquired date. Okay, no, the groups, okay. Yeah, so group one is what? My
Before
paper is getting full. Okay, group one
before
um
December 2.
is acquired prior to December 2, 1982. Okay, and then the group two, okay, these ones were those acquired after
December 1.
December 1, 19, I'm writing
82.
1982, okay,
But before
and after December 1, 1982, but before January 1,
27.
okay, but before January 1 of 2017. And we go to group 3. These ones are those after December 31st.
26.
Yeah, 2016, right?
Yes.
So, yeah, after December 1st, 2016. You see, when you look at group 3, at a glance, you'll be thinking, but this is supposed to come after group 1. Why are they putting 2016 after 2017? You get what I'm saying, right?
Yes.
But if you understood what I explained earlier, you will not be confused. All right. So I just wrote down those dates so that as we move further down, where we won't have access to the dates, we will need to be scrolling back and forth. Okay. Now G2 and G3 policies. For G2 policies, the key factor to determine the policy ACBs accumulate. Okay, so now let's look at the formula for each of these groups, because now the formula to calculate these three groups are different. Excuse me. So let's look at G1 form, how ACB is calculated for a group 1 policy. Okay, 178. Now, policies sometimes refer as grandfather policies. Like I said earlier, these group 1 policies are referred to as the grandfather policy. And you're going to see why. The reason is because they have the best calculation, until it's as though Canada Revenue Agency they were sleeping. They were sleeping and sleeping And then they suddenly woke up and say, oh my God, these people are making a ton of money. We got to, so let's see here. You see, so this policy are called grandfather policy. It's simply the cumulative premiums paid to date, less cumulative dividend paid out of the policy. Can you imagine? So in 1982 was over 30 years ago. Agents may still encounter active whole life or UL policies that were issued prior to December 2nd in 1982. And the ACB calculated under the old method will generally be higher than the ACB calculated under the method for G2 or G3. Remember that the policy gain is calculated as proceeds of disposition less ACB. So that is your policy gain, proceed of disposition minus your ACB. When you hear proceed of disposition, that is basically your cumulative fund, that is your cash value, your cash surrender value. Okay, now your policy gain is equal to proceed of disposition or cash value less minus your ACB. Now, we are on the journey of calculating our ACB, right? And we've gone through a lot of, through several villages, okay, to calculate this ACB, right? So now, for the group 1 village, right, the formula for calculating ACB, we saw it earlier. Where is it again? The ACB calculated under the old method with general, okay. So in 1982, blah, 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 blah. So the ACB calculated the general be higher, which is calculated method of group 2. Remember that the policy gain is calculated as the proceeds. The policy gain will be the proceeds, which is your cash value, right? Minus ACB, right? So, and I want to see, where's the formula for the old method? I thought we saw it just now. And ACB means a smaller policy gain and thus a smaller taxes for the policy holder. Okay, so this old policy is very straightforward. You just take your cash value minus your ACB, and then that will be your what? Your policy gain.
Your policy gain.
And based on the old method, the ACB is always higher. And what is the inverse result of a higher ACB on taxes that we talk on a policy gain and taxes that we discussed earlier?
You say the tax will be higher?
Sorry?
Say the tax will be higher?
No. When ACB is higher, policy gain will be lower and taxes will be lower. So we're going to see that, okay?
Okay, we'll say when ACB is higher.
ACB is lower, policy gain will be higher and taxes will be higher. So other tax advantages for those grandfather policies are covered in the section taxation of blah, blah, blah. Oh, they're not even giving us.
Can I get it? You said
Sorry?
when ACB is, sorry, can I get it? You said when ACB is lower.
So when ACB is lower, remember that 100,000 and
yes,
the 80,000 ACB I gave you, right?
Yes.
When ACB was 80,000, policy gain was 20,000. Therefore, client pays taxes on only 20,000, which is lower, right?
Oh, yes.
But when our ACB went up to 80,000, right? So that makes our policy gain, when our ACB went lower to 50,000.
Yes.
Our profit became how much?
50,000.
50K. Then we pay taxes on 50K. So the higher the ACB, the lower the policy gain, right? And then they lower the taxes paid. Then they lower the ACB, the higher the policy gain, and the higher the taxes paid. Got it?
Yes, sir. Yes,
But
ma'am.
don't worry, just understand the numbers. Don't Don't look at the inverse relation, the higher the this, no. Understand the principles. Okay.
Okay.
If you take your 100,000 and the expenses, it is a simple mathematics, right?
Mm-hmm. Mm-hmm.
If you are selling something, okay, and
Mm-hmm.
then your revenue, the money you make from the sale is 100,000, but to make that sale, you spend 50,000, your profit is 50,000, right?
Yes.
And of course, in Canada, because we pay taxes on everything, you must pay taxes on that 50,000, right?
Yes.
But now, when your expenses, let's say now, instead of 50,000, you spend 80,000, how much will now be your profit?
20.
20,000. Okay? Now,
Yes.
that will now make you pay taxes now on what?
20.
20,000. So that's the way you look at it.
Okay.
So group two policies. So I think a group one is very straightforward. So there's no this thing, right? Other tax advantage for these grandfather policies are covered in this. I don't know. They said they were going to see it in taxation. There's a taxation section. Some of you that have gone through your study materials, you would have seen it by now. So we're going to get to that. Okay, I got you guys. Don't worry. So we'll move on to group two. Oh my God, we're really moving slowly. Sure. For Group 2 and Group 3 policies, the key factor that determines the policy ACB is the cumulative premium, less net cost of your insurance. Okay, so let me go back a little bit. There's a place this formula is now. ACB, no, that gave us in 1982, the ACB is, hold on, where is the total cumulative premium paid? The ACB calculator under the old method would generally be okay. So in 1982 was 30 years ago. Sorry, guys, I'm going back to ACB calculation for group one, okay, because I want to extract that formula to show you guys. Okay, so the 30 years ago, agents, the ACB calculated under the old method would generally be higher. Okay, no, here, this is it. Okay. Um, let's see. Some example include adding rider. Policy sometimes refer to grandfathers. Simply cumulative premium paid today, less cumulative dividend paid out. Okay, yes. So this is what I'm looking for. So for your grandfather policy, your policy gain is equal to the proceed of disposition, in this case, which is your cash value. So in brackets, so you're going to have the cumulative premium paid, okay? Cumulative premium paid minus cumulative dividend received. Do you guys get it? So now go back to our example of 100,000 again. So we have a cash value of 100,000. Okay. So now they say that we minus, now let's say in this policy, based on this thing, we said clients have had this policy for how many years? For 10 years. Okay. So let's say every let me see, how much do I want to give these clients in premium? Let's say client pays, if clients pays 1,000 every year, that's only 10,000, right? Hello?
Yes,
So
that's
that
only
would be
10,000. Yes.
yeah.
Yes, 10,000.
So that would be 10,000 for 10 years, right?
Mm.
So that would be less than $100. Okay. So yeah. So let's say client pays total premium paid will be, let's say the total premium paid is what? 20,000. Okay.
Mhm.
And then maybe these clients have received dividend. Over the 10 years, maybe client receive another 1,000 dividend every year, right? So it means that the total dividend clients have received is how much? 10,000, right? Hello?
Yes, ma'am.
So the policy gain in this case will now be 100,000. In bracket to be 20K minus 10K. So the policy gain will now be 100K minus 10K, which means this policy have made profit of 90K.
90K.
And as such, the profit, the taxes will be on what?
90.
90,000. All right.
Yes, ma'am.
So this is a straight line calculation when it comes to the old grandfather policy. Let me show you. Remember that our initial example, right? So client's disposition amount is 100,000. So
Mhm.
we're going to minus, see, this is 100K.
Mhm.
So the total of all the premiums the clients have paid added together is 20,000. That is based on this, my own example, right?
Yes, ma'am.
And then the total dividend clients have received is 10,000. So when you minus that 10,000 from this 20,000, you got how much?
10,000.
10,000 is what you have. So did remove that 10,000 from the 100K, your profit is 90,000. So this client will pay taxes
Tax
on
on
that
90.
90,000. So, but now that is for group one. Then we're going to group two. So for group two now, this is group two policies. The key factor to determine the policy ACP are the cumulative premium less net cost of pure insurance. And then the net cost of pure insurance means the pure mortality cost. Do you understand? The pure mortality cost under the policy for a given year as different combination of the net amount at risk. Okay, so
Yes.
in the early years of the policy, the ACP of this is increased. So now what they are telling us is that for this group two and group three, the formula is no longer going to be a cumulative premium paid minus the money you receive in dividend. Let's okay, so this client now has the cash value is 100,000, right? So
Yes, ma'am.
and he has received a dividend, he has only put in this in, so he had made it's very straightforward. No, but this one now they are introducing net cost of pure insurance, right? So now they
Yes,
say
ma'am.
that for this one, so the ACB and the cumulative premium paid, so you still have your 100K minus in brackets the total premium, okay? The total
Okay.
premium less net cost of pure insurance. Total premium, cumulative premium minus net cost of pure insurance. And then the net cost of pure insurance is a measure of blah, 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 blah. Okay, so they are just explaining because so in the early year, so in this case, are they not talking about dividend anymore? So let's continue. Are you guys following? Are you guys
Yes.
following me? Now,
Yes,
in
we're
the
following.
early years, a policy is in the early years of the policy, ACB of the policy increases because the NCPI is less than the premium. However, as the life insured grows, as the life insured, where am I now? Sorry, however, as the life insured ages, His mortality risk increases to the point that the NCPI exceeds the premium and the ACB of the policy decreases over, and the ACB can reduce to zero, but it can never be negative. Wow. Regulations to the Income Tax Act describe different methods of calculating both the NCPI and the net amount at risk for Group 2 and Group 3. And these regulations also prescribe the use of updated standardized forever. Okay, so now let's go back. I need another paper. Guys, I have filled up all the sheets I brought up for this class. Okay, I still have more here. Thank goodness. So let me keep this handy. Yeah. So, wow. But something is not clear to me here is that they have told us that for Group 2, okay? So now we have our cash value, and they're telling us that now is our what? So our cash value now is our ACB is calculated as cumulative of premium less net cost of pure insurance. So back to our initial example, we have our 100,000, right? And then they say it's minus. Now our total cumulative premium from that our own personal example was how much? 20,000, right? We write it down. That's our cumulative premium. Now they are saying we should minus net cost of pure insurance from it, minus net cost of pure insurance. Now we broke down what net cost of pure insurance stands for yesterday. Okay, and that's where we spoke about. You see, when you pay your premium, there is and the net cost of pure insurance is determined by the mortality cost. That is the amount is costing the insurance company to insure that person for that particular year. You see, because there is a mortality rate, and the insurance company plans based on those statistics how many people are projected to die in that year. So that projection and the cost associated with paying those death benefits, those are the net cost of pure insurance. Okay, so down the NCPI, net cost of pure insurance, is measure of the pure mortality cost. The pure mortality cost, that is the number of people dying for that year under the policy for a given year. And it reflects the combination of the net amount at risk and the mortality risk for the life insured. So when we are calculating our net cost of pure insurance, we cannot detach it from net amount at risk. Remember, we discussed net amount at risk yesterday, right?
Yes,
And then we calculate it based on, is it level death benefit or is it cash value plus funds benefit? Do you guys remember? And then the other third one, that is guaranteed versus whatever. There were three of them. Okay, so if you watch yesterday's video, you're going to get a better understanding. Okay, and I remember telling you guys yesterday that I see all the time in our illustration software the level and the increase in which is the cash value plus funds. The other one is not that popular, but for the sake of exam, I recommended that you guys read up on it. And I explained yesterday how that impacts the net amount at risk. Gotcha. Okay. So that same principle is showing up here. So we've explained the net cost of pure insurance. You see, for example, for somebody paying $100 every month, the net cost of pure insurance, and you see, when it comes to term insurance, there's no net cost of pure insurance because everything is pure insurance. And that is why term insurance is very cheap. But when we start looking at this kind of permanent insurance that have investment, all the premiums a client pays is not only the insurance, the investment component. And remember when I told you guys that when the money comes in, it splits into two. One goes into the cost of pure insurance of that person, and the other one goes to investment. But before they start splitting up, their associated costs, admin fees, and all those kind of stuff that comes into play. I think I even drew something for you guys yesterday on that. Look at this. You see, we talked about the gross premium, where the premium tax is taken out, the admin expenses are taken, the mortality rate is taken. Then we have the bottom line, which is the net premium. Sorry, I just want to show you guys so that it will joggle your mind. See, I drew this to you guys yesterday, right? You guys remember?
Yes.
Right? Yeah. So you have that top line of the gross premium that comes in and how that gross premium splits into three, and then the bottom line is net premium, right? So this is where all this is coming from. So you have this, your pure what premium tax, you have admin cost, and then the mortality cost. It's from this mortality cost that the cost of pure insurance are derived from. Okay. So let's go on here. So that is on that. Now, I don't have enough information to make me want to do some calculations with respect to our own illustration we are using, but let's keep making progress. And I hope as what I'm breaking down, you guys are getting it. Okay, so in the early years of the policy, the ECB of the policy increases because the NCPI, the net cost of pure insurance, is less than the premiums. We discussed this yesterday because when somebody is younger, you see, when insurance company quoted you, for example, now, when you get a quote, for life insurance, and you are paying $200, right? Whatever they quoted is what you are going to be paying all through. If your policy is a limited premium policy where you are scheduled to pay the premium for a limited period of time, which may be 20 years or 30 years, right? So now, you are going to be paying this $200 every month for that 30 years. This $200 is not going to change. That's what you pay. But behind the scene, there's a driver. Because like we talked about YRT, right? There's something that calculates behind the scene. You don't need to worry yourself because the insurance company, they already have this data that calculate this net cost of pure insurance. Even this premium was given to you to pay. You see, that's how powerful the software that we are using is. And that's why I'm hoping that this week you guys will book appointment, because when I take you guys into the software and you see how this number, this thing will be demystified for you guys. Trust me. Okay? So now, for this person paying $200 premium, the net cost of pure insurance may just be $50. Okay? So now what the insurance company is saying now is that, okay, for this calculation of how much profit this person have made, right? So we're going to take, because this premium, this $200 this person pays us, that is not all the money that we use to insure this person, right? We are going to take out the net cost of pure insurance. So let's say this 20,000 that we've taken from this person, going back to our example of 20,000. So let's say we have this 100,000 minus, so instead of this 20,000 now, let's say the net cost of pure insurance is 50,000. Sorry, is 5,000, right? So it means that we're going to have 100,000 minus how much? 15,000. So therefore, the policy gain now will be how much? Tell me. Hello? So there's a way I can use whiteboard to do this thing, right? Let's see. Is there a whiteboard? I know there's a way to use whiteboard, remote control, summary. Anyways, that's something I could try to learn and figure out for the next class. Because if I can be writing all these things on the screen for you guys, maybe that will help rather than me trying to, you know. Kojo, have you left? It seems I'm on my own now, right? Anyways, so let me continue with you guys. So going back to that our example, so it therefore means that our policy gain now, okay, will now be 85,000, right? But again, we now notice that as the person ages, again, using this same example, right, as the person ages, we're going to see the trajectory of this net cost of pure insurance is going to be rising, okay? Because in the initial stage, this net cost of pure insurance may be smaller, right? So let's say later on, this net cost of pure insurance becomes what? So the policy cumulative premium may be 20,000. Then the net cost of pure insurance may be what? Maybe 19,000, right? So by the time you deduce that, so it means that the what? The ACB will now become 1,000. So this person will be left with 99,000 policy gain to pay profit on. And that's why I remember what I said earlier. With group one, Gary was sleeping. They woke up in 1982 and wondered, what have we done to ourselves? These guys are cashing out and they are paying less taxes. We need to come up with a way to make them gain more profit and pay more taxes. You see that? So that is what has happened here. And 179. Okay, so we move on to, and that is the way to calculate the group two and group three policies. So these differences becomes important when you recall that the policy gain upon the disposition of an individually owned life insurance policy is the difference between the proceeds and the ACB. Okay, now the situation becomes more complex if policy dividend, policy withdrawal, or policy loans are involved. Oh my God. So you're not going to see, but again, just understand that principles, right? That on this end, you have your total premium paid. Then you have your net cost of pure insurance that you deduct from the total premium. If you receive dividend, you have to remove that dividend from the premium paid. If you have policy loan, you have to, remove all those. Okay.
Okay.
Um, we are moving forward. Give me one quick example here to see any reference I'm making. The is all right, all right, all right. So there's a table here which are factors that affect, all these things. So again, like we do with every tables, policy loans, the factors and everything, please and please read this up. One thing I'm very happy about this class so far this morning is the fact that I took my time to explain this concept of, acquired date of policy, and then the groups of policies and those dates. See, when you get that, trust me, you're going to appreciate the subsequent events that follows. Okay. So I have no regrets for taking this much time to break it down for you guys the way I have done this morning. All right. So we are moving on to taxation of policy dividends. So we've looked at um, um, ACB, then we've looked at the impact of of withdrawal, not of withdrawal, of net cost of pure insurance on ACB. So net cost of pure insurance is typically deducted from your accumulated premiums. Okay, so now how about dividend? How is dividend taxed? Okay, according to the Income Tax Act, the payment of policy dividends triggers a deemed disposition of an interest in the insurance policy. Okay,
Okay.
so when you receive dividends, so the proceeds of dispositions are deemed to be the amount of the policy dividend less any amount that was used to pay an eligible premiums. So recall the following. Premiums paid by the policyholder increases the policy's ACB
By
by
the same amount.
same amount. Premium paid by the policyholder increases the policy adjusted cost basis by the same amount for premium paid. So if premium paid, okay, so we have premium, so if premium is 20,000, so that increase the policy's adjusted cost basis. Okay, yes. Yes, so our ACB, okay, yes, that I got that, okay. Because you see, when we are calculating on the right end, see, for our policy gain calculation, we have the left side is the cash value, and then on the left hand is where we do all the deductions, right? So that deduction is the cumulative of premiums paid, which is our ACB side, right? So the left side is our ACB, and then we have total premium paid, all right, minus whatever dividend. And then the dividend paid out to the policyholder reduces the ACB. That's right. Okay. So remember, so the ACB is the total premium paid, minus whatever dividend we receive. Okay. So as a result, most policy dividend paid out to the policyholder ends up being tax-free return of premium. That's true. That's true. That's true. So going back to that, our initial example, right? On this left hand, we have that cash value, which is 100,000. Then on this side, we have the calculation of our ACB. And we say that the calculation of our ACB is what? The total premium paid minus the total amount of dividend received. So going back to that, our example, total premium we paid was 20,000. Let's say we receive a dividend of 5,000. So we are going to minus 20,000 minus 5,000. Okay?
Yes, ma'am.
However, oh, are you there? I thought you've gone.
No, I'm here.
So, however, for group 2 policies, you see, this one is for group 1. You see, group 1 is very easy, very straightforward. I wish I know how to write on a whiteboard, right? So here, remember, you have cash value, proceed of disposition, or cash value. And on this side is where we do our ACB calculations. So this is the way I've structured this for you guys, for your remembrance. Can you guys see? So you see this left hand side is where we have, you know, the proceed of disposition, which is our ACB. Okay? I don't know if you guys can see it very well. Can you see? Yeah, you can see now, right?
Yes.
Then on the other end is where you have your ACB calculations. Now, for our ACB calculations, This is for grandfather policy, for group 1 policy. Group 1. So our ACB is what? Total premium minus total dividend received. Right? So if we pay total dividend premium of 20,000 and we receive 5,000 in dividend, so our ACB is how much?
You said if we receive.
Yeah?
You said if we receive. Hold on.
If our total premium we paid is 20,000
Okay.
and the total dividend we receive is 5,000, what is our ACB?
Is it 15,000? Are we minusing it?
15,000. That's correct.
15,000.
So now, if you now bring it back, now remember we said our cash value, which is a proceed from disposition, is 100,000, right?
Yes.
And we said the formula is cash value minus ACB. Now that our ACB is 15,000,
Yes.
so what is our profit?
100. 85.
That's good. So our profit now is 85,000. So it means we're going to pay taxes on 85,000.
85,000.
So this is for group 1.
Okay.
Okay? So now, see, I've done it like this. Yeah. Okay. Maybe I'll take a screenshot and post it in the group later. Okay?
Yes, because
But the way I write, I don't know you guys, it's just
if we
now.
follow it with a class, we'll be able to understand it.
Eh?
I say if we follow it up with the class, we'll be able to understand it.
Okay, that's good. So now we'll move on to group 2. So let me go back to the text now. Right? So now for group 2 policies, the premium for the purpose of calculating the ACB for tax purposes exclude the amount of policyholder pay for accidental death benefit, disability payment, ratings, or all these other ones. They will minus all these ones. Okay, so now for group 2, then for group 3 policies, for group policies, the full premiums are added to the ACB as they are paid. But the cost of insurance related to any of these non-death benefits is deducted. Okay, so now let's look at policy gain calculations. I'm rushing through this, but I don't quite like that because I don't want you guys to miss anything. Right? Let me dial back a little bit, because if I spend time to explain everything in detail so far, I might as well, walk you guys through it slowly to ensure that you guys get it. Okay. So now we've looked at group 1. Group 1 is very much straightforward. Okay. Now, they are telling us now for group 2 policies, the premiums for the purpose of calculating the policy's ACB for tax purposes exclude the amount the policyholder paid for accidental death. So if we exclude the amount, so it means that for group 2, so we have total premium we're going to minus, all right, the policyholder pay for the minus AD and D, right? So AD and D minus payments for A, D, and D, then and other benefits, okay? I don't want to start listing it. It's already listed here. So all these other benefits, accidental benefit, disability payment, ratings for substandard lives, the cost of conversion rights and guaranteed insurability benefit, or any other supplementary benefits. All right. So
Yes,
for
ma'am.
Group 3 policies, the full premiums are added to ACB as they are paid. But then the cost of, so no, this is talking about Group 3, this is talking about Group 2. So let me finish Group 2. So if Group 2 said the purpose of this, then if it exclude all this, so it means that my total premium minus whatever is paid for all these additional benefits will give me my ACB, right? So let's
Yes, ma'am.
say total premium coming from our previous listing is what? 20,000 using that same listing. And then the whole of all these supplementary listing, let's say, is another 5,000. So it therefore means that my ACB for Group 2 will now be what? 15,000,
15,000.
right? Okay. So now let's go to Group 3. Then here they are telling us something. So I think I love the way I've explained this Group 2 here. So let's look at Group 3. What are they saying? They say that policy for Group 3 policies, the full premiums are added to the ACB as they are paid. But our ACB is our total premium paid. So which ACB are they adding? Okay, the full premium. So are they referring to the premium of all these additional benefits? That may be it. Because our policy premium, so let's see G3. Say for G3 policies, the full premiums are added to the ACB as they are paid. But then the cost of insurance related to any of these non-death benefits is deducted from the ACB as they are attached to the policy. Because if a G2 or G3 policy includes these types of benefits, and if the policy dividends are eventually paid out to the policyholder, then the calculation of that gain is beyond the scope of this course. Hallelujah. Ah, my head wanted to burst. Okay, so what they are telling us is that for Group 3, you see
Yes,
how we have this additional benefit that we minus from the ACB, right?
yes, ma'am.
If it were to be ACB, right, it will now be total premium plus total all these
Benefit.
payments on additional benefits, okay?
Yes,
On additional
benefit.
benefits. Then minus net cost of pure insurance on the additional benefits. And then they now say that, well, when there's a dividend, then you start getting, oh my God, you start getting like a web from there. But they say something that is a relief. They now say all those calculations are beyond the scope of this course. So guys, don't bust your brain.
Okay.
So, so that is that a short brief listing on how the calculation of G1, G2, G3 is going to go down. Okay. When you
Okay.
guys start looking at chapter by chapter quizzes, based on this explanation, you'll be able to navigate. And the thing is that chapter by chapter quizzes is here to help you. Even when you get the answer, still review, read all the one you get, because for the first time you are doing those chapter by chapter quizzes, you might be guessing right to get some of the answers. So don't rejoice and say, yeah, I passed and then move on. No, go and read it, go and see why you get it right or why you get it wrong. And also review the wrong answers too, because with that you understand more the principles, okay?
Okay, ma'am.
So let's look at taxation of a full surrender. So now a policy holder is said to be fully surrendered a life insurance. What am I reading? Let's start again. A policyholder is said to fully surrender a life insurance policy when he cancels or terminates the policy, such that he has no further rights or obligations under that policy. So its full surrender is considered to be a disposition for tax purposes. Okay, so let's look at policy gain under such circumstances. So the policy gain calculation for a full surrender, um, a full surrender is, in the case of a full surrender, the proceeds of these dispositions are equal to the cash surrender value. I think I've already told you guys that. Even I say this thing, where is that my sheet? Oh my God, I've written a lot of stuff, guys. See, um, if you see here, I wrote it here at the beginning. Oh my God. Okay, so oh my God,
Blurry.
okay. I don't know, but anyway, sir, you guys just know that the the proceeds, you see what I wrote here is the proceed of disposition or cash value. Okay, your cash value is always referred to as the proceed of disposition. Okay. Mm-hmm. And that's why that is your CSV, cash surrender value. Okay. Uh-huh. Now to calculate your policy gain, it is equal to your cash surrender value minus any outstanding policy loan, including interest and everything. Okay. And then or any unpaid premiums less your ACB. So when is a total disposition, so the way the policy gain will be calculated is equal to, so whatever you have in your cash value, they are going to remove any loan, if you are having any loan, minus any loan, okay, minus any outstanding premium if you are owing the insurance company of any premium, unpaid premium prior to that time, and then minus your ACB, okay? So that will give you your profit. Now, remember, we've done ACB in 3 different groups. I'm blessed. So now, and this group is what will help us determine. So when you see your ACB, the next thing you look at is, when was this policy purchased? Put it down. Has this policy been transferred to another owner? If yes, what date was that? Put it down. Has the coverage of this policy been changed? Remember, now I'm talking about the dates, acquired date now, right? You put it down. So based on this acquired date, if there's any, then that tells you which group is this policy going to fall into. And then that will determine how you are going to calculate your ACB. If it's a group 1 grandfather policy, then your ACB calculation is straightforward. If it's group 2 and 3, of course, you know what to do. Right, guys? Okay.
Yes, ma'am.
So that is on that. And because I've established this foundation for you guys going to be just fine. You guys just so lucky, right? I just sat here and I broke down all these things so that you just come and run with it. I wish I had this opportunity, because these particular calculations, I know what it did to me during my own time. Anyways, if the policy holder of a G3 policy fully surrenders a policy with an outstanding policy loan, only the portion of the policy loan that was used to immediately pay premiums under the policy can be deducted. Oh, really? All right. Let's look at this an example. So if the policyholder of a G3 policy fully surrenders with an outstanding policy loan, typically for policy loan, we are supposed to, accumulated premium, all right,
Mm-hmm.
minus your ACB will be calculated based on accumulated premium minus whatever policy loan you are
Policy loan.
owing, right?
Yes.
But now they are telling us that for a G3 policy that is fully surrendered as a policy with an outstanding policy loan, only the portion of the policy loan that was used to immediately pay premiums under the policy can be deducted. Wow. So if there's 100,000 policy loan and 80,000 was a loan and 20,000 was a loan towards paying the premium, so it's only the 20K that can be deducted from the ACB.
The
Then what
ACB.
happens to the 80,000?
Uh-huh.
Will it be added to the ACB? I'm curious to know. So let's see here. This is so tiny. Where's my glasses? I can't see. Um, okay. Alicia is thinking about terminating a $200 whole life insurance contract, which is a G2 policy. And the policy has a cash surrender value of 24,000 and an ECB of 10,000. If she cancels the contract, Alicia will realize a policy gain of 14,000, which is 24,000 minus 10,000. And this will be fully taxable to her. A policy gain of 24,000 minus 10,000. Assuming her marginal tax rate is 35,000, this will result in a 4,900 taxable dollar. Alicia will have, but what I'm looking for is what explains this. This is a G1 straightforward kind of testing. Anyways, taxable of a particular surrender, a partial surrender occurs when coverage is reduced. For example, when the face amount is reduced in a universal life policy, a withdrawal is made from accumulating fund in the universal law. Those are partial reductions, right? So reducing coverage if the policyholder decides to reduce the amount of coverage. So for G2 policy, the policy gain on a partial surrender is calculated on a appropriated basis. So the cash surrender value and ACB used reflects the reduction in the coverage. For example, we can see that here. Okay. So again, just go through this and then policy withdrawal. And think from this point on, it's going to be a lot easier for you guys because you already have the background, right? So look at a prorated ECB. You see the amount withdrawn divided by cash value of the accumulated fund multiplied by ACB. So this
Okay.
is a prorated ACB. And this is applicable to a partial withdrawal or a partial policy withdrawal. Okay, so the example is here as well. So let's take time out to go through this, and then these are options to pay the loans once we withdraw loans, and then loan interest calculations, taxation of exempt versus non-tax exempt. So let's take a quick look at this one. So the issue of whether a policy is tax exempt or not applies or not applies only to a permanent life insurance policy. So what is required for a policy to be tax exempt? You see, last acquired date. You see, a tax exempt policy, and that's why we have to be careful with all these grandfathered policies, because those policies have a feature that does not exist anymore. You see,
Okay.
and those policies are so cool, so sweet, so amazing. You see, they put a lot of money back in the pockets of the policy owner. All right. So anything we see that still have 1982 or these G1 group policies, these grandfather policies, please respect those policies big time. Okay? Why is it important for a policy to be tax exempt? Well, a tax exempt policy provides the policyholder with a tax-free growth and investment income and in the universal life. So the way these are done now, like I explained yesterday, you see, is the insurance company keeps the gate. You see, okay, so this tax exempt, we discussed it yesterday. You guys, you remember the way I talked about, keeping the gate to ensure that, the growth in the plant does not explode to the point that it sends signals to CRA. So the way we do that now is so easy, but again, I would recommend you guys go through this and look at the MTAR rules and all that. Okay. And then the maximum actual tax reserve, that is what the MTAR rule stands for. Okay. So we move on to endowment of age 85 and the G2 policies. So again, now that I've broken down the groups for you guys, so when you look at all these when you see G2 now, you see G1, you already know on top of your mind what this is speaking to, right? For a G2 policies, the ETP is deemed to receive, okay? Let me see what the let me go back a little bit. Okay, we talked about MTAR of the ETP and report result, and then talked about this guy. So for G2, the ETP is deemed to receive annual deposit over 20 years, and the deposits are large enough to ensure that the policy will endow at age 85. In other words, for G2 policies, the enter line of the ETP describe an accumulated fund that will grow to equal the death benefit by the time the insured reaches age 85, based on a fixed deposit over 20 years. Okay, and growth and assume interest rate of 4% minus the cost of insurance. So the impact of changes implemented for Group 3 policies effective January 1, 2017 will vary by insurance company, but generally, but general, the maximum deposit permitted for a J3 policy while still maintaining exempt status. So basically, this is speaking to many at times a limited contribution policies. You see, like we discussed yesterday, when a policy is considered to have endowed, for example, if we choose a limited payment option and then the policies are paid off after 20 years, right? But that individual is not going to make any contribution. So what are the calculations used by the insurance company to ensure that this policy continue to grow, right? So that is what this is speaking to. Then we go on to the increasing face amount. Well, death benefit can be increased, which will also increase the death. Sorry, death benefit can be increased, which will also increase the death benefit of the exempt test policy, which raise the threshold. So one can increase the death benefit. Again, the maximum annualized increase is 8%. So that is the maximum of annual increase we can do as per death benefit. Okay. Withdrawing premiums. A withdrawal can be made. It will not result in a policy claim if the amount withdrawn is less than the prorated ACB. Okay, so how is this calculated? So James had a universal life with an ACB of 226 and a cash value of 100,000. So he has it to, if he withdraws 10,000, then the accumulated fund maintained is less than his ACB. So whenever the money you withdraw is less than your adjusted cost basis, then no tax will be triggered. Okay. And that's why when we tell people that Universal Life is an amazing program that you can withdraw money tax free, that is also accurate. Okay. Anti-don't rule. Okay, so this is speaking to the fact that universal life is very amazing. That doesn't mean that people can put as much money as they want into it. So there's a rule in place that controls the amount of money that people can put into the universal life policy. And that rule is called anti-don't rule. Okay. And that's why when we run illustration for clients, there's a maximum amount that an individual can contribute into their universal life plan. So take your time to read this. This is straightforward. Trust me, anywhere I feel we need to slow it down, I always slow it down. But where I'm not slowing down, I know you guys got this. So now, implication for minimum funded policy. I think I spoke briefly about this yesterday when some people will say, okay, I want to be contributing minimum policies. I go to my software and I pull a report for them and I make them sign that, look, if you are going with the route of this minimum premium, this is how long your policy can survive. And before this time, you need to start funding it properly. Otherwise, this policy will collapse, right? So again, read this, okay? And if a policy becomes non-exempt, well, what are the factors that can make a policy to become non-exempt? If so much money is put into the policy and then the growth exploded, right? So that could make the policy to become non-exempt, all right? So deemed disposition, we talked about this. Policy disposition, we talked about this. Tax advantages of older policies, those grandfather policies, those G1 policies. Hey guys, we talked about this. Then we talked about absolute assignments. Please read this one. Absolute assignment, I think there's another one called partial assignment, or to a non-arm's length party that is maybe it's transferred to a corporations and stuff like that. Please read this one. Assigning a policy to a spouse, what are the tax implications? Then options out of the spousal rollover. We need to read this one as well. Okay. Now, when we assign a policy to our children or a child, what happened after then? We got to read this one. All right. So these ones are just English, straightforward, whatever. You need to read.
Okay.
Then direct transfer, education funding, other intergenerational
Generational
transfers.
transfer.
We get to know this one again. Death of a policy holder, rollover to spouse, contingent policy holder. Okay, contingent is more or less like a backup policy holder, right?
Mm.
So when a parent sets up a policy for their children, they know that if anything happens to them, that child may not be able to pay that premium. So they can set up a contingent policy holder, which may be a trust or another individual. Okay.
Okay.
Mhm. Then taxation of life insurance strategies, and then using policy as a collateral. Okay. So we can read this one. And then borrowing for business use. that option. We need to read this one and the ACB. You can see that those ACB, NCPI calculations, annotating the cash surrender value, all this, you already have the foundation. So you guys will just be fine. Leveraging life insurance policy, collateralizing the cash surrender value, the interest paid on capitalized or capitalized insurance policies. All right. And then charitable givings. What are the benefits? What are the advantages of charitable giving when it comes to life insurance contract? Okay. The next one is assigning a new insurance policy to a charity. We can assign an existing or a new insurance contract to a charity organizations, and those comes with a huge benefit to the giver or the assign. Is it the assign no, right? So again, so this is the details when we assign an existing policy to a charity
Okay.
organization. So the essence of all this is for us to understand the tax benefits, okay? Managing taxes upon death. You see, when we tell people that dead people pay taxes in Canada, we are not exaggerating. You see, when somebody dies, they still need to file their final taxes, okay? They still need to file their final taxes. So all those things are things that we look at in this section. Whew, and that brings us, my neck, to the end of chapter 7.
Yes.
Thank you all very much. This is a long class. This is a ton of information, but I think it's all worth it. So go
Yes.
ahead. The areas you need to read them, do your practice questions, the chapter question. And like I said, and when you do, even the one you get the answers right, review them and do it again. All right. Thank you
Okay.
very much for your time, and
Thank you.
I will see you in the next class. Bye for now.